Good afternoon, everyone. My name is Courtney Drake. I'm with Avalara, and we're so happy to have you joining us for our webinar today, our mid-year update to 2024 tax changes. Today, I'm joined by tax experts from Avalara and Dillon Tax Consulting. We're going to spotlight some of the tax trends that they're seeing and the pending legislation that could impact your compliance obligations. Before we dive in, I wanted to go over just a few friendly reminders. Just a note, we are recording today's webinar, so if you'd like to listen to it again or even share it with a colleague, keep an eye on your email inboxes for the link to that within the next 24 hours. And then I also wanted to share some highlights on this orange webinar console that we're looking at. So first and foremost, some of you have already found it. There is a Q&A box over on the left-hand side of your console. You can use that box to submit your questions at any point over the next hour. Myself and a few of my colleagues are joining me on the back end to respond to questions individually. And then we do have time set aside somewhat throughout the presentation, and then hopefully at the end as well to dive into your questions. So keep them coming. There is also a community chat available on the console that you can use to interact with your fellow webinar attendees and network with other tax professionals like you if you're interested. If you'd like to check that out, click the icon at the bottom of your screen. It looks like 2 text message bubbles, and that attendee or community chat will pop up then. You can also click on that same text message bubble icon again to minimize the window if it gets too distracting at any point during the webinar. And then also we have some available resources and links on the console if you're interested in learning more about any of the topics that we'll be discussing today. All of those links will open up in a new tab and we'll be waiting for you when the webinar is over. And that's also where you can download your own copy of today's slide deck if you'd like to save them for later or just use them to get a sneak peek of what we're going to be covering today. I will say we do have some additional links in the slides to some of the legislation and news that we're going to be talking about. So if you'd like access to those, I would recommend downloading the slides and checking that out. And then finally, there is the ability to add reactions on the console. So if you want to let us know what you're thinking or feeling, there's a little smiley face down at the bottom of the console. You can click on that and see a list of available reactions and let us know what you're feeling. All right, before we go any further, just a disclaimer to get out of the way first, a friendly reminder that we cannot provide legal tax advice. Everything that we discuss today is for educational purposes only, but as always, we answer your questions the best that we can. And then we are offering 1 hour of continuing professional education today. So for those looking to receive CPE credit, please note that we'll ask you to respond to 3 out of 4 poll questions that will be appearing throughout the presentation. The poll questions will appear in the same window as the slides, so be sure to keep an eye out for those. And then you must also attend the presentation for at least 50 minutes. That's 50 minutes. And once you've met both of those requirements, your certificate will be available to download in that Earn Certification box on your screen. All right, without further ado, let's meet our 2 tax experts today. So first up, we are very happy to be joined by Mike Dillon. He is the founder of Dillon Tax Consulting. This is my first time working with him, and I'm really excited and glad to have him on. Mike, welcome to Avalara Webinars. Do you want to say a few words?
Yeah, absolutely. Thank you, Courtney. Hello, everyone. As it indicates there, I am an attorney, and for the past 30 years, I've worked exclusively in multi-state sales tax, both in-house with publicly traded companies at the tax helm and in leadership roles with some of the largest accounting firms in the country before heading out and starting my own practice 16 years ago. I think what's most relevant about that experience that I bring to bear with my clients is that not only do I have the experience that each of us has in terms of researching, analyzing, and trying to understand and implement tax rules as it relates to our business, but being able to bring a practical reality to those technical rules. So I think that's really something my clients appreciate about what I bring to bear, is that kind of the technical and the practical being married together. In other words, you can't really have sales tax rules kind of driving the bus, but they have to be on the bus.
That's right. Absolutely. Well, great to have you, Mike. Thanks for being here. And then next up, we have Scott Peterson. If you've joined one of Avalara's webinars in the past, you may have come across Scott a time or two. He is our Vice President of U.S. Tax Policy and Government Relations here at Avalara. So Scott, always great to have you on.
Thanks, Courtney. I appreciate it. And it's wonderful to have this with Mike today. He's a real expert in tax compliance around the United States. And we are thrilled to be able to highlight his practice and the work he's doing for his clients.
Absolutely. All right, well, let me do a quick overview of the agenda today. So we're going to start off by talking a little bit about how states and even a country are looking to increase the sales tax base. Some are looking at services and the taxation of digital goods and services as a way to increase revenue. And there's been some movement in that area, so we'll let you all know what we're seeing there. We'll also talk about economic nexus. There have been a few updates going on there with changes in the thresholds, and then there is some controversy maybe going on in one state, so we'll review that. We'll discuss the soon upcoming Minnesota retail delivery fee, what's going on there, and then we'll end by zooming out and taking a look at e-invoicing mandates and some of the changes we're seeing there across the globe, not just in the US, so important if you're doing business internationally. And then, like I said, we do have time set aside for Q&A at the very end. So with that, Mike, I'm going to pass the microphone over to you and let you kick us off today.
Thank you. Some historical context before we dive into some of the specific state examples. I think e-commerce and technology-based services have really moved consumption from point of sale and on-site provision of services to the electronic delivery and remote access to new goods and services, as well as digital counterparts to goods and services that have always existed. And what that really means is now we've got declining tax bases, and states are struggling politically and pragmatically to figure out how to expand their tax base to address these new services, new digital goods, as well as kind of digital counterparts to services and goods that they've always taxed, but now have a digital replicate kind of existing that has kind of supplanted something they've taxed, and they're trying to figure out, well, how do we tax that new thing? So Maryland, historically, this is my state, has only taxed 11 services. You kind of start when you look at sales tax, every state pretty much taxes almost all tangible personal property unless they exempt it. And then they only tax services if they specifically say we tax services, with the exception of a few states that have a more broad-based kind of gross receipts tax, like New Mexico and Hawaii, West Virginia. So Maryland taxed very few services. And so House Bill 1515 is really an effort to add on to what they did a couple of years ago when they began taxing digital products and their efforts to tax digital advertising, and really broaden it very, very broad, really, to tax all sorts of services: business services, professional services, information services, repair and maintenance, building repair. And these are really things that small businesses rely on and have to purchase externally in order to support their business functions, as opposed to larger companies that can often internalize a lot of these things, like accounting and legal services. So if these things were taxed under this bill, it would really have a significant burden and impact on smaller businesses, and certainly something that I think this kind of died in committee. It never really got anywhere, and the General Assembly in Maryland is now ended. But I think, as we'll see in Nebraska, it's not, Maryland has done it before. Nebraska is calling for it now, a special session in the fall to reinvigorate these efforts to kind of overhaul their tax scheme. So I wouldn't surprise me if Maryland did the same in the fall and brought this up again next year in an effort to reinvigorate the tax scheme and raise additional tax revenues, because kind of most states, since the kind of pop from post-Wayfair era, sales tax revenues have really kind of flattened across most states. So this is an effort to try and raise more revenue in Maryland. But again, it didn't go anywhere. Nebraska's EPIC option is one example of Nebraska's efforts to provide property tax relief by really overhauling their entire state tax structure. The EPIC option would eliminate really many of the other taxes in the state, income tax, property tax, and inheritance taxes, and replace them with a statewide consumption tax of 7%. And that would even apply to things like digital advertising, which is interesting and probably fraught with all sorts of problems. The problem with it is that 7.5% is probably not high enough of a tax rate to allow for budget neutrality and replace the tax it seeks to replace, replace the revenue that this tax seeks to replace. Also, the bigger problem is really that local government would lose the autonomy they have in regulating property taxes if property taxes are taken away. So the governor has vowed to call a special legislative session if necessary, and that is in the news that he has done so. I think the other thing is that we've seen is Vermont, House Bill 887, enacted this, so this actually did happen, a new bill to impose a 3% surcharge on short-term rentals. And interestingly, Vermont has always had an exemption, well, at least for the past 10 years, since 2015, had an exemption for cloud-based software or SaaS. And they did away with that exemption as part of this bill. So effective July 1 of 2024, pre-written computer software, including remotely accessed software, is subject to sales tax. It's included in the state's definition of tangible personal property and is subject to sales tax in Vermont. Virginia they looked at what Maryland did a couple years ago and said, we too are going to try and move forward and impose sales tax on digital property and services. And it did not get anywhere in Virginia. Much like in Maryland, the Virginia governor vowed to veto anything that came in front of him. Unlike Maryland, where the Maryland governor vetoed the legislation and the General Assembly overrode that veto, it just died in the Virginia Senate. It didn't go anywhere. But again, these are indicative of state efforts, and they're not going to go away. I think they're going to continue for years to come. Some of the other things as we look at, we mentioned Maryland, digital advertising tax. Many states are interested in doing the same thing, and we'll talk about what Canada's doing in that inroads in a minute. But California, Nebraska, Tennessee, we see there, DC, have all expressed interest in taxing digital advertising. The problem as they watch what's happening in Maryland is how do we define the tax base and who is responsible and how is it sourced to our jurisdiction when this stuff is really global. And they're watching what's happening in Maryland. And Maryland, of course, is just embroiled in a legal battle. If you ask the state, they'll say it's in full force and effect. And of course, the Maryland Supreme Court did uphold the imposition of the tax in the past year. But at the federal level, the Federal Court of Appeals said that the U.S. District Court can hear the petitioner's First Amendment challenges to the digital advertising tax in Maryland. So we're still kind of stuck in limbo, trying to wait to see whether this tax moves forward or not. In Canada, Canada has expressed interest and said they're going to move forward with passing a digital services tax that would impose a 3% tax on all gross revenues from really anything online. Online marketplace revenue, social media platforms, the sales and use of user data, and digital advertising. So very broad based. And of course, I'm not a big fan of gross receipts taxes because it's going to have a regressive impact on unprofitable businesses. If it's a 3% tax on your gross revenue and you're not a profitable business, it has your effective tax rate is much higher on every dollar of profit you've made than a highly profitable business. In other words, that $3 on every $100 of revenue that you make hurts a lot more if you're a unprofitable or your profit margins are low. I don't know if you had anything to add there, Scott, to any of these pieces.
Yeah, so the conversations around the taxation of services are mostly around how do I tax things that are delivered digitally that I tax when they're delivered in a tangible format. I mean, so many of the things that we're seeing today, and arguably that's what happened in Vermont, is, Vermont taxes computer software when you deliver it in a tangible format. Now, I don't think that actually happens anymore. I mean, it rarely does one, unless it comes loaded on in your computer when you buy your computer, and then you have a bundled transaction. But So most of what we've seen over the last few years is simply trying to bring what state legislators thought was their existing tax base into into the future, which is, yes, we tax tangible personal property, we tax music, we tax records, we tax the sale of CDs. We should also tax streaming music services because it's essentially the same concept. I'm not buying a CD, I'm buying the music. The other conversations are much more philosophical, and they're around elimination of existing other taxes. The conversation going on in Nebraska is around property taxes. Property taxes are a very popular political concept this year. Every state's talking about property taxes. And so what the governor of Nebraska wants to do is raise other taxes, including what effectively is a digital advertising tax, to raise revenue to make significant reductions in the amount of property tax that the people in Nebraska pay. Same conversation goes on in Mississippi in the last 3 years, where the governor wants to repeal their income taxes. The only way to do that is to broaden other taxes. We will see when the Louisiana legislature comes back next year. We're going to have exactly the same conversation. The governor and the current Secretary of Revenue in Louisiana, both big advocates of eliminating their income taxes. And the only way to do that is to raise some other tax.
I like what you said about, that we've always taxed it when it was tangible personal property off the shelf. So naturally, we want to try and tax it in its digital format or electronic format. I actually had a recent example in an audit with a client, a Maryland audit, and a client that provides installation and monitoring of security services. And they're basically a construction contractor. When they're installing this equipment into residences and commercial buildings, they're paying the tax on this equipment when they buy it, and then they install it, much like construction contractors would. The state audited them and looked at their wireless components that they're installing and said, this is no longer real property installation because these things aren't connected to the building. So this is kind of an example of things in their wireless state now being taxed differently than the historically wired counterpart. A bit of a stretch in terms of the digital, kind of counterparts to things, but it shows kind of the broad reach. As we move more towards digital and wireless features in our economy, you can have different tax impositions. So this comptroller looked at this and said, this wireless cameras and detectors and wireless access key card type things that aren't connected to the building by wires anymore, when you sell them, you're a retailer, you need to charge sales tax on the retail sale. We want 100% of the retail price, not your cost. So it's an opportunity, a revenue opportunity for states, and a shift in the way taxpayers have to look at their business going forward. I think my last example there is kind of a good example of what we will continue to see, is that oftentimes the audit activity, as I mentioned, it's kind of politically difficult for states to impose what is perceived as a new tax, even when they expand the tax base to tax kind of the digital counterpart of music and movies, things and software, things they always tax. It's perceived as a new tax to their constituents. So oftentimes what we see is increased audit activity that provides clarification for the state's tax policies and expansion of their tax rules. And I think we'll continue to see that. That example I just gave is an example of that. And just, I found an interesting fact I was reading the other day that in 2008, Apple launched their App Store with 500 apps. 500 apps. Today, there's over 4 million apps just on the App Store. And this is just apps on one giant platform. So we got numerous platforms with apps, software, music, movies, other digital goods and services that never existed before. And states want a piece of that. The biggest problem I think we'll see with taxing services and digital products is always going to be classification of what they are, how do they fit in something the state defines as taxable, and how they're sourced. Do we get to tax that thing? And we'll talk more about that in this case coming up after this question. But first, I want to kind of finish this slide with what at least the Streamlined Sales Tax Governing Board providing some measure of uniformity or consistency or guidance that even states that aren't part of streamlined sales tax, they can pick and choose and say, well, we like that, and we're going to apply that same thing. And that's happened with definitions and sourcing for non-member states. So Streamlined Sales Tax Governing Board is looking at amending the agreement as it applies to the sale of digital goods, and as it relates to kind of the sourcing, the situs of the transaction. In the absence of reliable customer information for which to situs that transaction, permitting them to use 9-digit and 5-digit zip codes, which in and of itself, as a former telecom tax guy, is fraught with all sorts of problems, because I can assure you that the use of a 5-digit zip code, it will not produce accurate local taxing. It just simply won't. You can have, and I have seen, an example, Colorado localities with their home rule cities would hire contract auditors to come in and audit their local telecom tax revenues. And they knew that if for certain services we were, in the absence of other information like street address, we're using state, city, and 5-digit zip, they knew there were problems with that, because you can have two customers on opposite sides of the street in the same city, same street, and they're in different local tax jurisdictions. One is subject to a stadium authority tax and the other is not. One's subject to the regional transportation district tax, the other is not. Same street. So that's the problem with 5-digit zip, and it is what it is. I think 9-digit provides a little bit more reliability, but in the absence of other information, it's kind of, you got to take the best that you can get. And the other problem with it is kind of data privacy and whether or not government is permitted or retailers are required to obtain certain information about customers, where they're located and what they're buying, what they're using, and whether the governments have the right to access that information in tax administration.
Courtney, let's do a slide, or a poll, excuse me.
Close enough. Poll, slide, same thing. But this is our first CPE poll. So for those of you asking, make sure that you're looking at your screen. It's going to appear in the same window that the slides appear. So our first question, we'll give you guys just a few minutes or a few seconds to look at this. But what has been the most challenging aspect of managing tax compliance for your company in 2024? And this is one where you can actually choose all that apply. And then we will take a look at the results in just a few seconds. In the meantime, there have been a couple of questions that came in on Canada's digital services tax. Do we know when that's going to go into effect? I think it just received what they call royal assent.
Yeah, has it received a royal assent yet? Oh, it did. Okay. Yeah, I'll be honest with you that we're not as up to date on that as we should be. We just saw it, just trying to figure out what it all means.
The effective date is supposed to be January 1 of 2024, but actually have retroactive application to January of 22.
Oh, wow.
22?
Yeah.
Good Lord.
So keep an eye out on that. I think it sounds like there's still more developing, but I might ask Gail to do a blog about that soon. All right, well, let's take a look at our poll results here. So we had several different options for everyone to choose from here. I think not surprisingly, keeping up with these changing tax laws and guidelines, we asked this question in many of our presentations, and that continues to be among the top two. And this one, it actually was the close one, with determining nexus following not far behind. We're going to talk a little bit more about nexus in an upcoming section. And then you have calculating sales tax rates. So managing exempt sales actually beat the calculation, also not surprising. And then remitting returns, and then international tax requirements. So thanks everyone for participating in that. And I'm going to pass the mic back to Mike to talk a little bit about some news going on in use tax.
Thanks, Courtney. So I think this case, the South Dakota Supreme Court decision in Ellingson Drainage, has some relevant application as we talk about the problem I mentioned with sourcing digital goods and services. So Ellingson Drainage, Minnesota construction contractor, when they bought all their equipment in Minnesota, they didn't pay tax on it. They bring it into South Dakota, sometimes for just one day for use in completing construction work. South Dakota audits them and says, you owe use tax on this stuff at 100% of its value. So if it's 2 years old and it's got a 10-year life, we're taxing it at 80%. but we're going to get 100% of the 80% kind of thing. And Ellingson Drainage obviously doesn't like this. They appeal it, claiming that this violates the Commerce Clause, specifically under the fair apportionment test. There were some other arguments they made, but the most relevant, because it's been appealed to the US Supreme Court, is the fair apportionment test under the 4-prong complete auto transit standard for evaluating whether or not state taxation violates Commerce Clause. What Ellingson said was, look, taxing 100% of things that 90+% of the time are used outside the state of South Dakota fails to appropriately allocate the tax relative to our in-state usage. And the South Dakota Supreme Court said, look, use is use, 1 day or 100 days. You pay tax when you use it in our state. And our use tax provisions, much like most states, one, they provide a use tax credit for tax paid to other states, and two, they don't contemplate a method for measuring the amount of usage in the state. And we think that this is okay under the US Constitution. You know, on appeal, I think what the issue before the US Supreme Court, should they grant petition, and I don't think that's going to happen before they end their session at the end of this month. I think what's going to happen is they will look at this in conference in September and decide whether to grant or deny the petition. But the issue is whether or not an unapportioned use tax violates the Commerce Clause. My issue with this, as I look at digital goods and services, is you have to be careful what you ask for, the law of unintended consequences. You know, apportioning the usage of something based on the number of days it's used in a state and its measurable life works for stuff like construction equipment, but it doesn't work for digital goods and services that can be used over and over and over again, arguably have no useful life. They have no shelf life. A digital item could be used forever, like software or a movie. And arguably it could be used in multiple states during the same session of usage. You're using it while driving in a car and you're traveling across state lines. Which state has the right to tax it, or do both states have the right if they don't provide some sort of credit? So that's the issue I really have. So it'll be an interesting case to watch because it could have far-reaching ripple effects to the taxation of digital goods and services.
Yeah, use tax is always a hard thing for a Department of Revenue because, you know, arguably one could, and which is why in most states you see a statute that says that if someone moves into the state, there's a specific dollar exemption for the stuff that the personal property they brought in with them that they don't owe a use tax on. Otherwise, I mean, I went to South Dakota this weekend for my family reunion and I got a haircut 2 weeks ago. South Dakota taxes haircuts. I live in Tennessee. Tennessee doesn't tax haircuts. I was using my haircut when I was in South Dakota and arguably owed use tax on the value of that haircut. It's impossible. And so this one is, which is why these issues always come up in audits, because the state absolutely has no idea who's inside the state, who's doing something that they're using inside the state they didn't pay tax on somewhere else. So this will be an interesting case. So let's talk about economic nexus. You know, there hasn't been a lot of there really arguably isn't many places one can go where the states can go in economic nexus changes. The only thing that they really have that they disagree on, which are things that are obviously that make the economic nexus very complicated, are the thresholds and the definition of what a sale is. And what we're seeing there's a tiny trend going on here the last few years, may accelerate here soon, is eliminating the 200 transaction component to economic nexus. You know, South Dakota had a very specific reason, a very specific type of transaction in mind when they included the 200 transaction component to their economic nexus threshold, which is the one that the Supreme Court decided to use to overturn the physical presence test. And that creates anomalies that are every bit as abhorrent as what we had with physical presence. I mean, one of the things that the Supreme Court said when they repealed the physical presence test was that being physically present imposed bizarre outcomes. You could be the smallest retailer in the world who had to collect sales tax everywhere simply because the only way you could do what you do was to be physically present inside of a state. Somebody who repairs wells. You repair wells, you can't repair wells very well anyway, at least not successfully, remotely, but you can sell remotely. And so the Supreme Court said we created an odd outcome, the physical presence. They wanted to repeal that. The 200 transaction thing created the same thing. I mean, we have customers that sell things that cost 75 cents, and they may sell thousands of things that cost 75 cents, and honestly never get to the $100,000 transaction component that South Dakota otherwise has. It may only sell, a few dozen 75-cent things, or 201 75-cent things, create a sales tax obligation, and remit literally nothing in sales tax. So Indiana and Wyoming have removed it. We thought Utah was going to remove it this year, but the fiscal note there was a fiscal note, first of all, which kind of surprised me. And the legislature used the fiscal note to not pass that legislation. They thought it was going to cost them too much money. I have no idea how they figured out that was a fiscal note. We have we have two cases in Illinois challenging on a constitutional grounds the way Illinois is imposing its economic nexus requirements. Illinois is an origin sourcing state, always has been an origin sourcing state, which means that if you're inside Illinois, the tax that you collect is the one based upon where you are located. It's fairly common. Utah, Tennessee, Texas, lots of states have origin sourcing. That isn't the rule that they imposed for sellers who are outside the state. If you're outside the state, you collect the tax in effect where your customer takes possession of the product you sold them. That rate is likely different than a rate that they would pay if they bought that same product from somebody in Illinois. And the obligation to track the hundreds of different local governments inside of Illinois is radically greater than the administrative obligation imposed upon a retailer selling from one jurisdiction. And both in-state, out-of-state, selling the same stuff to exactly the same customers inside Illinois will have remarkably different administrative obligations to remit the tax in Illinois. And you'll notice I didn't say sales tax or use tax, because what Illinois imposes is weird. They don't call it a sales tax or a use tax.
What's interesting about this, Scott, is that, and you actually have under the Illinois scheme, 3 sets of taxpayers. You've got the remote seller, you've got the in-state seller, and you've got the remote seller with in-state presence who gets the tax just 6.25%. So, Illinois can't seem to get out of its own way, because it seems to me they did the same thing with affiliate nexus standards years ago, and that was struck down by the courts as violating the Internet Tax Freedom Act, because it treated online sellers differently than other retailers. And then they tried to revamp it and revise it and broaden it. But it's interesting. They seem to keep stepping on their own toes with their efforts. Revenue. It is. And it's some of this is a function of the tax structure they have. They've got this, because of a previous constitutional case in Illinois, they've got this odd sales tax. And then they have an origin sourcing tax, which in origin sourcing, it's really politically hard to move from origin sourcing to destination sourcing, because there are so many jurisdictions inside of a state that over the decades have used origin sourcing as a way to entice businesses to locate there. So there's lots of places in Illinois and every other place where where the tax is posed on an origin basis, where there's distribution centers located in individual cities, and they get all this tax from that. I mean, this is an issue in Texas. This is an issue in California today. This was an issue in Washington. When Washington went from origin sourcing to destination sourcing, the legislature appropriated additional money and put it into a pool that they then divided amongst the cities that had warehouses that lost money because they went to destination sourcing. And that lasted for several years. So it's politically, it's very hard. There's cities out there that lose a lot of money. There's businesses that have to change. And so it's a mess. But Illinois is a mess times and times. So this is the map. This map is relatively simple because it doesn't include the definition of sale. And what we have around the country, you take this map of the different economic nexus thresholds and then lay over the top of this map the states that use retail sales
the states that use taxable sales, and the states that use gross sales. And when you add those over the top of this map gets really complicated really quickly. I like to use South Dakota and North Dakota as an example. Both of them have a $100,000 economic nexus threshold. North Dakota's uses, I think, taxable sales, and South Dakota uses gross sales. So if you sell exactly the same thing, exactly the same type of people in North Dakota as you do in South Dakota, you're almost certainly going to get to the $100,000 and have economic nexus in South Dakota before you do in North Dakota, depending upon what you sell and who you sell it to. If you sell things to people that are exempt, you could arguably never get to economic nexus in North Dakota, whereas South Dakota, A, they use gross sales, they don't care who you're selling it to, and B, they tax a lot more nonprofits and charities than North Dakota does. North Dakota exempts most charities. South Dakota exempts very few charities. So if you're selling things to the Catholic Church in North Dakota and South Dakota, it's taxable in South Dakota and it's exempt in North Dakota. So you're going to have an economic nexus obligation in South Dakota, whereas you may never have one in North Dakota.
So Scott, as we look at that map, it's good to see states continue the trend of doing away with the arbitrary transaction count. But, Washington used to have for their B&O, the economic nexus threshold, that they would continually adjust every year for inflation. And it kind of strikes me, 100,000 is arbitrary too, because it's meaningless when you're comparing one state to another and one taxpayer to another. But these numbers, if they're just static for a decade, they become even more arbitrary. Is there any discussion at all among states for adjusting these things for inflation?
Very briefly, and it turned into, and it was a very brief conversation because it got really complicated very quickly. The streamlined sales tax states that pay companies like Avalara to provide sales tax compliance services for remote retailers, they very quickly started to say, well, we agree inflation will erode the value of $100,000 over time, but since I'm paying the retailers, since I'm paying Avalara or the other CSPs to provide that service for them, why should there be a threshold at all?
Right.
And so the conversation ended, but you're absolutely right. That economic nexus threshold will erode over time with inflation. Yeah. Courtney, let's do another poll.
Yep, here's our second poll question. So this webinar is actually based on the written Avalara Tax Changes 2024 Mid-Year Update. You can find that in the related resources section. But when thinking about the Avalara Tax Changes, all of the campaigns that we do around it, we're curious, what do you find the most useful? And you can select all that apply here, but we have three options. Is it learning about the recent and upcoming tax changes? Maybe understanding the broader commerce and industry trends, or is it seeing the relevant data points about those trends? We'll leave that up for just a couple of seconds. Going back to economic nexus, do those thresholds reset every year?
Yes.
Yes.
Calendar year, or every it could be a rolling 4 quarters or 12 months. It depends on the state. So yes, you're measuring look back period will reset depending upon whatever the look back period is for that state, whether it's every month, every quarter, or every calendar year.
Got it.
And another unnecessary complexity. Illinois and California, it's a rolling 4 quarters. Their sales tax return is quarterly. So it's just weird. But technically, yes, it resets every year, but every state has this look back period. It's if you exceed $100,000 in sales in our state in the current calendar year or the preceding calendar year. So if you made $100,000 in sales into a state in 2023, but you're not going to make it in 2024, well, you did make it in 2023. So that's the preceding calendar year. So you've got to go all the way to 2025 and then look at 2024. And then you get to guess whether or not you'll make it in 2025. It's complicated. Definitely. What's our poll say there, Courtney?
All right. So not surprisingly, everybody wants to know about the actual tax changes, but we do have a spattering that like to see some of those broader industry trends and then the relevant data points around those. So thanks everyone for responding to that. And then Mike, I'm going to pass it over to you to talk about retail delivery fees.
Yeah, I think, everyone's familiar with the Colorado retail delivery fee. The most notable news is that it increases next week from 28 cents to 29 cents. And this is a fee, not a tax. Important that they point that out. And I get it. It's meant to impose the revenue, the tax imposition really, on the people that are benefiting from the use of the highways that are being overburdened with all these delivery vehicles that have replaced commerce, from we used to go to the store and buy things and bring them home to I can order them on Amazon and they're delivered to my door. So the roads are getting overused, transportation infrastructure funds need to be replenished, and this is a means of doing so while imposing the burden directly on those primarily benefiting from the roads. And another thing I think states have mentioned is that, as more vehicles go to hybrid and more fuel efficient vehicles, then fuel taxes are going down as well. So that revenue source is diminishing. So they're trying to add an additional revenue source. They did kind of add this small business exemption that took effect previously. In Minnesota, what everyone's probably more concerned with is this will take effect, this new retail delivery fee will take effect July 1st of 2024. The intent is really to do what Colorado is doing, but it will impose a similar but different 50% fee on all retail delivery fees, not just taxable ones, and even orders of goods that aren't taxable, like clothing. Clothing isn't taxable in Minnesota, but the fee will still apply to the purchase and delivery of clothing online. The legislature was trying to make it easier for small businesses by doing things like on orders totaling $100 or more, that just creates a whole new layer of complexity to the imposition and collection of this thing, because now you got to figure out which orders cross over that $100,000 threshold, or that $100 threshold, and then impose the fee on just those orders and not the others. And so they've made it more difficult rather than simpler by just saying it applies to everything. New York City are also considering this retail delivery fee. So I think this is something just like digital advertising taxes. We're going to keep seeing this in more states dance around this, perhaps adopt it. But there's going to be a lot of discussion about these fees over the next 10 years.
Yeah, Minnesota, go ahead, start the poll, Courtney.
Oh, well, we'll just leave this up while you're going over it. But this is our next poll. So how automated are your tax compliance processes, ranging from 5 to 1? So we'll keep that up, Scott, but go ahead.
When the Minnesota legislature when they thought this up and they looked at what Colorado did, they sincerely looked at the complaints that businesses had about the way Colorado did it. And they made the argument that they eliminated, the worst, and maybe they did or maybe they didn't. So instead of like Colorado, where you have a separate return, they are going to let you report this on the sales tax return. So saves you money, and arguably eliminates some of the complexity with having to file 2 returns every month in a state. And they immediately put in an economic nexus threshold. But to Mike's point, they put in 2 economic nexus threshold. They put in the you don't have to collect this at all if you're below a certain amount, if you're below a certain number of total sales. And then they added this: if the sale itself is less than a certain amount, you don't have to collect it, even if you have to collect it otherwise. So they doubled down on the economic nexus threshold, and just, which makes it very complicated. And then clothing. There are a lot of people who sell clothing. Minnesota only taxes clothing with fur on it. And there are a lot of people who sell clothing into Minnesota that don't have a sales tax license at all, because they sell something that's exempt from the tax. And this fee applies to deliveries of clothing inside of Minnesota. So there's going to be a lot of people that have to have a license of some form or another and remit a sales tax return just to remit that fee without having any sales tax to remit. It's a very, very odd and confusing outcome.
Yep. A couple of quick questions on that. So we've been kind of barraged with questions about the RDFs, which we thought might happen. But for the Minnesota one, is it $1 million for the threshold, $1 million in Minnesota sales only, or is it the organization's total sales?
Minnesota sales.
Okay. And then also for Minnesota, is it separate form for compliance that they'll have to remit, or is it included within another return?
They're going to change their sales tax return and add a place to add this on.
Okay.
And that applies to both the normal sales tax return and the simplified electronic return that folks like us file because of the streamlined sales tax.
Okay. And one clarifying question just came in about that. So the adjustment for the 50-cent delivery fee for Minnesota will need to be added to the July return when it's filed in August, or will it not go into effect?
Yes.
Is that true?
Yeah, this goes into effect on July 1st. So all sales starting on and after July 1st may or may not be subject to the retail delivery fee, depending upon the exceptions. And yes, that will be on that's their Minnesota's intent to have that reported on the July return filed in August.
Yep. Okay. All right. Well, let's take a look real quick at our poll results. So looks like the majority of people, almost 50%, are saying there's someone in the middle about automating their sales tax compliance. We have almost 20%, 17% that said they've automated almost everything, which is very impressive. And then on the other end of that, 13% who are in the very early stages of automation. So thanks, everyone. That was our third poll. We'll have one more, but I'm going to pass it over to Scott to talk about what's going on internationally.
The rest of the world uses the value, and as such, there is a quirk in the way value-added taxes work that make them susceptible to fraud. And this in a value-added tax, everybody has a license, everybody files a return, everybody charges the value-added tax, and the value-added tax applies at every step in the business cycle of a product. And then you get a credit when you sell your thing to somebody else. You charge them the value-added tax, and you get a credit for the value-added tax that you paid to the person you bought your thing from. Well, some fraudsters have figured out that you can submit a credit invoice to the government to get tax back when there was no sale at all. And so what they've been doing started doing several years ago, which is spreading, is this obligation that every invoice has to be electronic, and it has to be structured the way that particular government wants to see it. And then they're going down the next step, which is to force you at some point in this process to give the government the detail behind every transaction. You either give them the invoice up front, they approve it, which is what they do in Brazil. You give them the invoice after the fact. They store it, they record it. They expect to see, they expect to stop giving credits to people for that invoice if they don't see that invoice in the future, or they require you to remit your sales transactions data on some sort of basis. This it's going to go across all of Europe, and it's slowed down somewhat because of the complexity that goes along with having e-invoicing, because everybody has to change their invoicing software. The invoicing software business, as I have caught up, they're doing things now in a format that's applicable. One of the challenges is that every country has a slightly different version of e-invoicing. Every country has a slightly different version of how you get that data to the government. And we have a ways to go. I think the challenge for folks the U.S. folks who sell, in countries that have a VAT, is they expect you to comply with their, the value-added tax. And that's going to come along with an expectation to comply with their e-invoicing mandates as well. And do you want to have an invoicing concept or an invoicing software that is different for the U.S. than it is in the rest of the world? So that will be a challenge that everybody has to go through. This is just a little graph on how these things have progressed. They started back in 2000 with Brazil, and they're moving into 2030, where we expect these things to, and a lot of these things have changed, but most of they've just slowed down, and they haven't really changed that much. So this will be our future. It'll be everybody's future who does business outside of the United States. We'll see, in the United States, we've got what we call in the United States, there was a thing created called the Digital Business Network Alliance. Oop, come on, slide deck. Oop, I thought we had another slide in there. Never mind. And that slide's the next one after the poll, isn't it? Yeah.
You're right.
So
yeah. Somehow they got disconnected there.
Poll. Yeah, poll. This is not a poll. This is a catch.
This is a last question. So actually, let's go ahead and show that slide that you were talking about, and then we'll go back to the poll in just a minute. Okay,
thank you. So e-invoicing works at a country level. It doesn't work at a state level. So it would be extremely complicated for Wyoming to impose an e-invoicing standard on anybody doing business in Wyoming, because there's so many people outside the United States, so many people outside the world, or outside the United States and in the United States to do business in Wyoming. Germany can do this because Germany can enforce something nationwide. The United States doesn't have any real interest in e-invoicing. There's nothing that there's no tax that the U.S. imposes. Well, there is, but there's no tax the U.S. imposes that's equivalent to a state sales tax that would cause the U.S. to create an e-invoicing standard and then mandate that on every business in the United States. But there is business efficiency that comes from e-invoicing. They're quicker, they're more accurate, and the ability to understand invoice after invoice is radically reduced if they're all looking alike. And so there's a thing called the Digital Business Networks Alliance that was created in 2023. Avalara is on the board of directors of that is creating an e-invoicing standard for the United States and encouraging businesses in the United States to adapt and adopt the concept as simply as a way of reducing or increasing the efficiency associated with passing invoices from companies to companies. There's another project that's going on that everyone should keep in the back of their mind, which is called the Federal Reserve's FedNow program. And what the feds are trying to do is reduce the cost and increase the time and reduce the cost and reduce the time it takes to move money from point A to point B. We've changed a lot in the last 10 years when it comes to moving money. We can move money very quickly today. That before you had to write a check and it could take 2-3 weeks sometimes to get money from one account to another account. And so what the Fed's trying to do is figure out a way of getting to near instantaneous movement of money, which for us is, if they can reduce the cost, obviously if I can move my money, in Avalara remits billions of dollars in taxes to governments for our customers, the shorter amount of time it takes us to do that, the longer that money can stay in your checking account, because we don't need it as quickly as we do today to be able to do that. And if it can cost less money, that everybody's a winner on that. The downside is someday when this all is in effect, some government's going to say, it's cheap to move money and you can do it instantaneously. I'd like to get it every day, please. So those conversations go on around the country, and we'll see if that takes hold once we get to instantaneous movement. Let's go back.
There it is. Sorry, I moved it on you again. But this is our last and final poll question. So we'll leave this up just for a minute. But that was our final section. So we'll take the last few minutes to go into Q&A. And not surprisingly, there have been quite a few that have come in on the retail delivery fees. One of them was explaining the difference or clarifying the difference between retail sales and marketplace sales as it applies to the retail delivery fees. Either one of you have thoughts on that?
Sure. So if you're a retailer with an online presence, then you would be responsible for collecting the Minnesota retail delivery fee, assuming you have economic nexus, and then also that your sales cross the threshold, the economic threshold that the state has imposed specifically for the retail delivery fee of $1 million in Minnesota retail sales. So if you have economic nexus, which clearly you would if you cross $1 million and are responsible for the retail delivery fee, you would have sales tax nexus in the state. And you would then have to collect on any orders over $100 that occur on your retail presence. If you also sell Amazon or other online marketplaces, they're responsible for that. You don't, just like they're responsible for collecting any sales tax for sales that are made under your retail account on their marketplace, they're responsible for the retail delivery fee in Minnesota, same as in Colorado.
Got it. Thank you. And then also along the RDF lines, someone was asking, so that Scott, this is a question for you. Will Avalara automatically add in the Minnesota retail delivery fee, or is it something that they have to apply a special tax code for?
You have to send us a specific tax code.
Yeah. And,
Okay.
and that, yeah, as someone who does compliance work for clients, you need to ensure if you're, let's say you're using a Fi platform or something like that, you need to pass an individual line item with a $0 amount associated with that, so that product code can be mapped to the retail delivery fee tax code in Avatax, so that the 29 cents in Colorado or 50 cents in Minnesota can be applied to that product code.
Yeah, so and that reminds me, one of the things that Minnesota did that Colorado did the second year was give retailers the ability to either pass the fee on to their customers or to pay it on their own. But if you pass it on to your customers, it has to be shown on the invoice. There's got to be a separate line item.
Okay. And then one last question about Minnesota's retail delivery fee. So this person says they don't have a physical location in Minnesota, but make deliveries to customers there. So would they still be, I guess, does the delivery fee still apply to them? And would it be classified as a marketplace or just a retail? And I think that depends.
Well, I'd like to know more about a little more facts, but if they're delivering products in their own vehicles, that's physical presence. So they've always had an obligation to collect the state sales tax. It doesn't make any difference who owns the vehicle that delivers the product. Right. It's a delivery. It's subject to the retail delivery fee.
Okay.
Yeah.
I would agree with that.
Okay. All right. We are right at the top of the hour, 1 minute past it looks like. But I did want to thank our presenters. Mike, thank you for joining this webinar. Really, it was great having your expertise on here. And Scott, as always, thank you for everything that you do. Any closing comments from either one of you?
Just stay connected, stay tuned into the experts, because this stuff is just going to continue to change and evolve. Even the things that currently exist, like economic nexus standards, continually change. And then in addition, states will continue to seek additional revenue for these new products and services that are out there.
Absolutely.
Said it perfectly, Mike. Thank you. Absolutely.
So just a final reminder for folks, if you're interested in learning more about what Mike does, we do have a link to his website on the console, so you can check that out. They also have a blog there talking about some of the latest issues. And then you will have access to the same console in the link that's sent out to you with the recording. So if you want to check out any of those additional resources after the fact, don't worry, you're not going to lose access. You can see this console and access all of the links there. Just a final reminder, if you did qualify for CPE credit, you should see your view certificate icon in that box, and you can go ahead and click on that and download it now. And then I also wanted to do just a quick plug for Avalara Crush, which is our customer event that's coming up in November in Austin. So it's a really great way to meet other Avalara customers like yourself, if you are a customer, and also learn more about the topics that we're discussing today. So I think there's going to be a track on tax changes that we'll be covering there. Scott, I think you're going to be there. So it's a great presentation, or a great day. A few days actually, to learn more about what's going on in tax and how you can make the most out of your Avalara account with us. So if you're interested in learning more, visit avalaracrush.com to check that out. And
I'll be there too, so I hope to meet many of you there.
Absolutely. Yep. It's going to be a fun few days. So again, thank you everyone for spending the last hour with us, and we'll see you very soon for one of our future webinars. Have a great day.